Yeah, my hope is that after hearing the words of Jessica Koch, everybody is excited as I am to take a deep dive into the world of retail media. And I can't think of anybody better to give the first keynote. His name is Daniel Knapp. Daniel Knapp is Chief Economist at the Internet Advertising Bureau. IAB, it's the European level association for the digital marketing and advertising ecosystem. With more than 15 years of experience as an industry analyst, he has worked with regulators, Fortune 500 companies, and startups. As a professional who not only works at the intersection of regulation, market analysis, and strategic advice, but who also sees data ethics as one of his heartful issues, you can learn from the best of the best in some seconds. Today, Daniel will share key insights and statistics about the status quo European retail media market and where it will go next. He supports the bold thesis that retail media has a unique ability to convert economic and post-disruption into a strategic advantage. But are we dealing with a post-pandemic hangover, or is the power of retail media here to stay? You will find out more in his keynote, so please welcome Daniel Knapp. The stage is yours.
Wonderful. Thank you so much, and a warm welcome to everybody all across Europe for a full day of retail media. As Jonas said, I'm an analyst, meaning I focus on data. And the topic of today's event is into the data. So buckle up for half an hour of jam-packed statistics on how the retail media market in Europe is going to unfold and what the future is going to hold. So we are in a particular time after the pandemic, after massive growth in e-commerce and the explosion of retail media. Is this going to continue? Or are we seeing a digital hangover? Is retail media overrated? This is the topic that I want to explore today in the next 30 minutes. But before we look in the future, we need to take a look far back into the past to really set the scene. What you can see here is a Roman calendar. And it was the last year that the Roman calendar existed. The year 46 before Christ, also called the Annus Confusionis, the year of confusion. Why is this important? Because back then, the Romans switched from a kind of messy and entangled calendar, which had gone out of whack with the times, to a new, simpler calendar. And they called it this year of confusion. I think, in the world of marketing, we're in exactly the same time right now. It's a year of confusion, and we don't know whether this year is going to be 365 days, 400 days, 435 days, like that longest year in Roman history, because so many things are coming together. Macroeconomic challenges, structural changes in the industry, how we work with cookies, and so forth. But out of the combination of these cyclical and structural factors, new winners are going to be born. So this is already a spoiler alert to the question, is retail media overrated or a boom? I tell you, it's going to be a boom, but we want to do that in an empirical, evidence-driven way, so let's get going. There is some kind of digital hangover looming all around us right now. We are in a particular situation which the Germans, they have a term for everything, is called Krisenbilder, or as the economic historian Adam Tooze says, polycrisis. The spaghetti of different arrows you can see on this chart really show that we're not dealing with a very simple economic crisis like the Lehman crash in 08-09. No, it's multi-causal. Each of these different factors here are connected and they're amplifying each other. And what you can see in red here are so-called macroscopic events, i.e. if any of those things happens, all bets are off. Meaning there's high uncertainty right now how the macro future is going to shape up. And we all know that advertising is quite a nervous industry in the sense that it overreacts to economic trends. So does this mean we're seeing a retrenchment of advertising, or is all still good? Well, we had the key drivers of digital ads in 2020 and 2021, and one of those was cheap money. As an analyst, this here is one of my favorite charts. It shows the 5,000-year history of interest rates across the globe. And what you can see here is that interest rates are now, or until around 9 months ago, on a 5,000-year low. Meaning even the ancient Egyptians could borrow money as cheaply as we could just until the tail end of 2021. And this cheap money, a lot of venture capital money, has been pumped into D2C brands, e-com brands, and so forth. And of course, a lot of that money was reserved for advertising, to grow share of voice, to acquire customers, and so forth. But this era of cheap money, as we all know, is now over. So there's a specter hanging over the industry. We could also see that past growth, and by the way, digital advertising grew 2021 in Europe by a whopping 30.5%. A key driver of this was SMEs, or small and medium-sized enterprises. They were really propping up the market predominantly by pushing on social. What you can see here on this chart is on the left, you've got the large Fortune 500 brands, the FMCGs and so forth, how much they spend on digital ads out of a total budget. It's round about, we estimate, 40%. Now fast forward to the right side of this chart, and you can see the share of digital ad spend by SMEs, meaning for them, digital is and has been the key channel, the principal channel to drive growth. So with a massive overexposure to SMEs in digital ads. But can they really invest more in digital advertising? Because what we can see is a saturation. CPMs on social are going up, it's kind of hard to acquire more customers, etc. So this kind of natural dynamic is coming slowly to an end. And as we all know, although we gather today virtually, we know the world hasn't turned entirely into a Zoom economy. In fact, we're back in a physical world. I try to express this by correlating maybe the quintessential pandemic stock, Zoom. You can see the inception of Zoom, the IPO here in May 2019, and then the massive surge during the lockdowns, and then how it went down. And I overlaid, this is the lighter line here, the passenger numbers of Europe's biggest airport, Heathrow, over this. And we all know correlation isn't causation, but the picture is pretty clear. We are not in a digital-first economy. The physical world's coming back. And that is kind of removing some oxygen for digital ad growth overall. And many were saying confidently, well, e-commerce is exploding so much, we're going to make a 4-year leap in 3 months. It looked like that not long ago. What you can see here is data from the UK Office of National Statistics. You can see the share of retail spend, consumer retail spend, that's going online. You can see this was a linear curve, really, with some blips for seasonal cyclicality, and then a massive exponential growth during the pandemic. And we thought, yes, we'll make this massive leap. But there's a phenomenon called reversion to the mean. And this is what we're currently experiencing, where we're moving back to linear growth patterns. So this leap, it was short-lived. Good news is, of course, we as an industry have built a transaction, a targeting, an attribution infrastructure to capitalize on future growth as this exponential surge happened. So we are still in a robust e-commerce environment, although we see the data now auto-correcting itself. Now, focusing on spend, it means that overall e-commerce growth, not advertising, overall e-commerce growth is actually slowing down. You can see on the left here the January 22 forecast of e-commerce growth in Europe by Statista. What we did at IAB Europe is we spoke with national institutes and researchers to revise this forecast now in October 2022. And you can see some downturn here. And there's this white space in the middle. And you can see this means in the next 2 years, there's around 108 billion euros less of e-commerce spend overall available going around in Europe, which actually means that ad dollars need to work harder to convert e-commerce customers really into long-term sales. So with all of this, with these economic headwinds, are we in an economically induced ad recession? Are all bets off? Should we be gloomy? I don't think so. And this chart tells us. Now, let's look on the left here. I went through company reports, the quarterly filings of some of the largest companies in advertising. On the left, I labeled them big tech, the usual suspects. You've got your Amazons, your Snaps, Google, Twitter, Meta. On the right, we've got the agencies. And what's remarkable is how different these growth trends look like. You've got quarter 1, 2022 and quarter 2, 2022. And what you see on the left here, on the big tech side, is a radical slowdown. In particular, look at Twitter, look at Meta, even negative. But then on the agency side, different. Not only faster growth overall, but also an acceleration in Q2 versus Q1. What's happening here? We seem to be living in 2 worlds at once. a doom and gloom world and a happy hyper-growth world at the same time? Well, I think it's pretty clear that when we look at the headlines, different things are happening. On the one hand, big tech, struggling with recessionary headwinds, laying off staff, hiring freezes. On the other, agency holding companies even upping their guidance. We're now in the middle of results season, i.e. WPP results out, Omnicom results out for Q3, and they all actually reaffirm this trend. Meaning, what's currently happening is predominantly not headwinds from the economy. It's still going pretty all right, but it's about structural things happening in advertising. In particular, Apple's ATT, the deprecation of third-party cookies, and so forth. And these are aspects impacting, in particular, large platforms who have relied on third-party data in the past. So, to dissect this confusing picture, there are 5 trends. Number one, we see very mixed signals from advertisers. Some are spending less, but some are spending more in the travel category, in the auto category, and so forth. And typically, what we can see is that it is marketing-driven organizations, i.e. those who revise budgets once a year, who continue to spend. But those who are kind of hyper-sales-driven, they are much more technical in their spend, and they are adjusting things, putting them downwards, or sales go up, upwards, etc. So different trends happening. We can also see this divergence, which we believe is going to continue until Q1 2023 between big tech and agencies. We can see this e-commerce slowdown as this VC money dries up as interest rates go up, as I mentioned. And we can also see that it's currently the structural factors that are more important than the cyclical downturn. What obscures all of this and makes life very difficult for me as a forecaster is we got massive spend flowing into the market from China. As the Chinese economy itself, the domestic economy, is slowing down, but shipping costs, container costs, how much does it cost to put a container from Shanghai to Antwerp? They are on historically low levels, down from $20,000 a couple of months ago to around $2,000, making the European market very attractive to those Chinese sellers. Hard for me to forecast because we don't really know what's going on, how many of those there are, but this is also propping up the market. Regardless of that, at IB Europe, we have revised downwards our overall outlook for digital ads. In May 2022, a couple of months ago, I was still fairly optimistic for 2022, predicting a 10.1% year-on-year growth. That's now down to around 7%. And I'm more skeptical overall for 2023, with now only a 2.4% growth for digital ads. Note, though, that all media is down, i.e. traditional media down double-digit likely, before we're going to see a recovery emerging in 2024, meaning there's a delayed effect on the macro recessionary impacts. But I already mentioned that the structural issues are actually something that really, really demand our attention. And I know Jess is going to speak more about that in a second. But fundamentally, discussions globally around privacy, regulatory discussions, sociocultural issues, they are redefining what privacy means and how we as an ad industry need to react to this. And you already see I'm a history lover. This is the Stockholm telephone tower at the beginning of the 20th century. What you can see here, all these different wires are one phone line into a single housing block. If you picked up the phone in Stockholm and someone was on the line speaking to their grandmother and so forth, the entire housing block could listen in. This was a huge privacy concern, not just in Stockholm, also in New York, where you had massive phone penetration. And Wired magazine of the 19th century, American electrician, actually put out this quote: "We shall soon be nothing but transparent heaps of jelly to one another." Doesn't this sound like a privacy advocate, a data protection advocate in 2022 could have said this? Right. Because always there's been a tension between technological advancements and how we as a society define and deal with privacy. It was resolved back then. Nobody's talking about phone lines anymore, and I'm very confident that we are on the same productive path now in digital ads. But there's work to do, and there are going to be some winners in this world. To outline what's really happening, let's imagine the post-third-party cookie world on a spectrum of identifiability, i.e. how you can identify consumers. On the very left here, you can see logged-in users with email, credit card, and so forth. Previously, that was just the refuge of the large platforms, but in particular, you can see retail media emerging as a key category here. You have publishers now with shared ID solutions or building segments, and you can see already we're moving, as we look at the right part of the chart, away from individual people to groups, averages, and cohorts, up to context, where we have no identifiable information about people and groups at all. The future will be the smart combination of all of those things. But the ad industry is racing for solutions. And one thing, of course, is the world of M&A. Hectic M&A activity we saw in 2021. You can see it here in first-party data, in ID solutions, in contextual. If you just look at the timeline here and the estimated value, a lot of bets are being put on the future of addressability. And first-party data, of course, reigns supreme. And we know retailers have a lot of that. But often what's happening is that brands are removed one step from consumers, meaning they don't have that much first-party data themselves and need help with this. And it's also a huge legal issue and a battle in the organization to really unlock its power. So what we can see here is the spend in digital advertising per category. Retail, automotive, financial services, telecoms, and so forth. How big are they? And I put some emojis next to each category to see how ready is each of these sectors to tap into first-party data. Typically, the closer you are to the consumer transaction, the more and the easier you can do things. But not every sector is equipped, meaning brands need help, for instance, from retailers. This world of first-party data is not an open world. It's a world that's becoming more closed and fragmented. And the Germans of you all know this guy, Walter Ulbricht, who just before the Berlin Wall was built said, nobody has an intention to ever build a wall. Well, we know the future was quite different, and we have this wall building, not in the physical kind, also in digital ads. We're moving away from an open internet to a fragmented world of splinternets, i.e. of dedicated walled gardens that are hermetically sealed, which makes advertising targeting, attribution, and measurement incredibly harder. We have different worlds operating in parallel. The Google universe, the Apple internet increasingly, Facebook, Amazon, the open web itself, i.e. cookie-based, is also fragmenting, as I showed you earlier. But then we've got new challenger gardens. Not all of them are walled, some are hedged, i.e. more porous, more focused on collaboration. And you can see in here, a key factor in this is, of course, retail media as a source of consumer attention, transaction, and so forth, which is not only going to be one splinternet, but also, as you can see in this chart here, a connective tissue to the overall open web. So those are the cyclical and the structural factors now raining hard on our precious world of digital ads. In this, retail media is in a remarkably advantageous position to unlock growth despite uncertainty and despite headwinds. So there is no digital hangover for retail media at all. It's booming. Overall, we can see globally, if we look at e-commerce, we can see two players really stand out globally, Alibaba and Amazon. Then things tail off, but we can see, because they are so huge, the others are still massive in terms of gross merchandise value. When we look at Europe, there's one player only in the top 20 globally. But we need to take a more European-centric perspective here in this forum to understand where are growth opportunities in e-commerce, in the retail space for us. Overall, the top 20 make nearly 70% of the overall market, excluding Asia 20%, so massive innovation happening in Asia. Europe overall, on a global scale, is fairly small. But the good news for Europe is we have a very strong roster of endemic retailers, i.e. homegrown retailers that are rooted in their markets and open to collaboration. And of course here, Douglas is part of this as well. And this world of these retailers, with ad-funded business models, is growing far above the overall rate of digital ads, as you can see here. So here we've got my forecasts that I showed you earlier for digital ads totally. Next to it, retail media ad spend. There's a remarkable difference between those two. And you can see, as we're moving into an economic downturn, retail media, we expect, is going to surge, growing by a factor of 7.8x faster than the overall market. This, of course, means we have measurability, we have conversions, we have that elusive first-party data, which is all, and near immunity from Apple ATT, which is all putting money into this channel. And If we stack it up across all other digital channels, we can see it's actually leading the way. So this is a ranked chart. You can see retail media growing faster than search, faster than audio, faster than the old growth driver video, for instance. And notably, look in the middle of this chart, faster than social. And I think this is in particular remarkable as we see a lot of headwinds with social and budget migrations out of social coming into retail media now, as there is clear data, less dependence on the structural targeting issues and so forth, and also more attractive and measurable, more attractive CPMs and more measurable outcomes as ad exposure and conversion is merged into the same platform, i.e. no signal blindness like the ones that Meta are currently facing. Overall, this means we expect the European retail media ad market. This is ad inventory sold on retailers and also what's happening offsite, including advertisers that are selling on platforms of retail media and also non-endemic ones, retailers and marketplaces, including Amazon, to reach 25 billion euros by the end of our forecasting period in 2026. And already today, it's a 7.9 billion euro market. This certainly isn't small fry. And let's try to visualize how this looks like. So we got here the world of 2021, on the right side, the world of 2026. And today, retail media, from an ad spend perspective, is already as big as ad spend in printed newspapers, excluding digital. So the former mainstay of ads, newspapers, is on par with retail media. In 2026, the world's going to look remarkably different. Because by then, if we look at the latest Group M data for linear television ads, retail media is going to be bigger than TV. I know that's a bold statement, but I stand by it because the data is clear. Meaning, this is not an emerging channel. This is not something optional. It is actually now an integral pillar of the overall ad economy. I think we can visualize this better and really demonstrate the impact by comparing retail media to search. Here, we have time since year zero, i.e. The year zero for search really was 2008, the Lehman crisis. When the economy collapsed, search was growing because it was performance-based, evidence-driven, and you had massive, clear conversions. The year zero for retail media was the pandemic, the growth of e-commerce, etc. And we can see each from a year zero is growing massively, and we can actually see as retail media is happening in a more mature digital world where more advertisers focus on digital, the growth is actually in the overall volume to outstrip search. Both are crisis kids, i.e. they cut their teeth in times when they were tough, and they are going to thrive in and beyond those times. Although Amazon is the elephant in the room, there's clearly growth beyond Amazon. And we believe that endemic European players, European retailers and marketplaces are going to grow faster than Amazon. You can see the picture of 2020 versus 2025 here, how the European endemics are growing share to about at least 30% of the overall retail market. Now we know European ad markets are hugely different. There isn't just one single European digital ad market. They all have their own dynamics. I love this chart here because it shows us so many things at once. The size of the bubble is the size of the market. On the x-axis, you can see digital ad spend per head or per capita, i.e. how mature is the market. And on the y-axis, you can see how dynamic is the market, how fast it's growing. You can kind of see that the UK is a planet of its own, right at the right end here of the chart. You can see, of course, massive dynamism in emerging countries. Spoiler alert, in Turkey, it's partly driven by inflation. But you can also see how large some of the big European markets are. Germany, for instance, France, but also how much headroom for growth there is still in markets like Italy and Spain. Massive in terms of population, large TV ad markets, but still headroom for growth in digital as they're still underdeveloped. And this also means there is still massive headroom for growth for retail media. So here we try to split out the retail media ad market by country. The UK leads, followed by Germany, France, Italy, Spain, and so forth. But we can also see Poland being a massive market, although a CEE market behaving much more like a Western European market. What I did here is, you see these dots on the chart. And these dots here are the retail media share of overall e-commerce expenditure. Everything above the dotted line is mature. Everything below it is below the average of these countries here. Meaning, when we look at France, Italy, Spain, even the Netherlands, Switzerland, and Austria, there is a lot of headroom for growth. Just as e-commerce is going to grow, retail media has the natural potential to actually grow its share, and we expect retail media to outperform overall e-com growth by around 2.5 to 3x for the next couple of years. It's also something, of course, not happening only on retailer sites. One of the key future components of retail media for us is offsite. So we can see currently a strong concentration on on-site as retailers and marketplaces are building their offerings with their rich first-party data, but increasingly saying we want to do more. We want to be full funnel and moving to other media with their first-party data. Social commerce is one of those things using search and SEO, but also we're already seeing it in awareness campaigns, i.e. retailer data being used to activate CTV campaigns and so forth. We expect this to accelerate as inventory and CPMs mature on retailer pages fairly quickly from 2024 onwards. Now, for advertisers, retail media isn't just about buying ad inventory. We did a little survey in IB Europe, still ongoing, but here's a sneak preview for you, where we asked, how does your organization, as an advertiser, really use retail media? And for many, it's not just about buying, but also about, as you can see here, about the insights and product development, i.e. it's more about the feedback loop you get from retailer data than just buying inventory. And similarly, what many advertisers want is access to that elusive transaction data, just on the very left here. Now, why is this important? Because I think if we look at overall e-commerce business models, and here's a typical waterfall chart of how e-com business models look like, you can see that fairly thin EBITDA margin at the right end of this. You can see a big bucket of this is SG&A, Services, General, and Administration. Super boring name, but advertising is in there. And in a world where advertising is fragmented across the splinternet, the cost of that is going up, affecting overall e-com margins. But if you do that within a closed platform that has ad exposure and attribution, you can actually reduce overall SG&A cost, i.e. increasing the profitability of your overall e-com model. And this means we need to be bold. We need to think beyond media and think about the retail and how media enables retail, which means to me, the markets of advertising, marketing, rents, store rents, and also shipping, it's actually the same market. We used to ask in advertising this question: what does it cost to elicit a certain consumer response to my message? This isn't the only question we should be asking, and retail media can do that. We need to ask, what does it actually cost to deliver those goods to reach a certain consumer, i.e. the cost of logistics, of shipping. What you can already see in innovative solutions in retail media is you can see ad targeting to those people who live close to the warehouse or where the shipment cost is low. Meaning the world of the CMO, the advertising question, and the world of the CFO, the overall profitability of the e-com model, they are merging. And through smart retail media strategies, we can start to combine these questions into a single infrastructure for generating consumer and brand value. This means to me, to conclude, retail media isn't just a boom, it is a strategic moat. It can be a fortress for brands, for agencies, and also for retailers to really solidify business models. What's a moat? A moat is a feature of a business model that protects it from disruption and enhances its competitive position. Meaning, working with retailers in the retail media space can overcome cyclical issues and structural issues in digital advertising and set things up for future growth. Meaning, although I'm a discompassionate statistician and numbers guy, I'm extremely bullish about this market, and it's great we're having this event today to dig deeper into the opportunities. With that, thank you so much for your attention, and I look forward to seeing you later today.
Daniel, thanks for the energy, for the great insight, and that you've come all the way from London to this event. So we really appreciate. And as you said, we will see you. That's a good message. We will see you back on the stage again for the panel discussion. So thank you very much, Daniel Knapp.